You have probably heard someone tell you that structured bonds are necessary for real portfolio optimization. That sentence carries authority, but it also carries a quietly dangerous assumption about complexity and worth. The belief that more complicated equals better has become a cultural default in finance, and it deserves pushing back. This video will untangle that fallacy through clear examples, practical rules, and a handful of uncomfortable truths. By the end, you will know when complexity actually adds value, and when it is merely a cost disguised as sophistication. The claim we are interrogating is simple to state and hard to swallow simultaneously. People say, you need to invest in structured bonds for complexity, as if complexity were an investment objective instead of a tool for specific problems. In the next scenes, we will explain what structured bonds actually are, why they developed the way they did, and the decision framework you can use to know whether complexity buys you anything worth paying for. Structured bonds are financial instruments that blend a bond with one or more derivative elements to change cash flows or risk exposures. They pair a fixed income backbone with options, swaps, or contingent clauses to create non-linear payoffs that target particular investor goals. These instruments often carry names like principal, protected notes, or reverse convertibles, and they were invented to meet bespoke client needs that plain bonds could not match directly. Understanding that genesis will help us evaluate whether the complexity is justified in each case. The technical creation of a structured bond usually starts with a cash bond and a derivative overlay designed to alter risk and return. Dealers piece together zero-coupon bonds, options, and credit hedges to manufacture a payoff that looks like whatever the investor requested. That structure depends on pricing models, counterparty agreements, and sometimes complex triggers that activate different cash flows under specific market conditions. Each of those levers adds another layer of assumptions, and those assumptions are where value can either be created or lost. Complexity in structured bonds wears many different faces, from exotic payoff formulas to conditional coupons, and knock-in, knock-out barriers. Those features are mathematically elegant and intellectually attractive, but they also make valuation, transparency, and liquidity more difficult for ordinary investors. Every additional feature requires models, assumptions, and calibration to market data, and that increases the product's sensitivity to model error and mispricing. Complexity therefore transfers the burden from simple cash flows to abstract parameter choices that few retail investors can validate. But complexity is not always gratuitous or maliciously deployed for salesmanship and opacity. Structured bonds were often created to solve real problems for real clients, such as hedging complex liabilities or achieving a regulatory or tax outcome that plain bonds could not deliver. Understanding the legitimate problems that drove the creation of structured products helps us avoid throwing the baby out with the bathwater. Complexity, when aligned tightly with a clearly defined need, can be the right tool for the job. So when do structured bonds actually make sense for an investor seeking real outcomes rather than theatrical complexity? They make sense when there is a specific liability, tax constraint, or hedging requirement that cannot be replicated cheaply by simple instruments. For example, insurance companies with predictable but non-linear liabilities sometimes genuinely need tailored payoffs to immunize their balance sheets. In these cases, complexity buys certainty in ways that plain instruments cannot match without either cost or distortion. Conversely, many retail and even institutional investors encounter structured bonds in situations where simpler solutions would have sufficed at lower cost. Sales teams often present complexity as added value while charging for model-driven hedges and embedded fees. If your objective is yield enhancement on a short time frame or broad diversification across public markets, simple bonds, ETFs, or basic option overlays can often deliver similar outcomes with greater transparency and lower fees. Understanding the cost structure of structured bonds is vital because fees hide inside valuations, hedges, and counterparty spreads rather than appearing as explicit line items. Dealers embed costs in option pricing, in the credit spread of the issuer, and in liquidity adjustments that are hard to observe. That opacity means investors often pay for expertise they cannot verify, and without a strong reason to accept those hidden costs, the product becomes economically suboptimal. Scrutinizing price drivers will often expose cheaper, clearer alternatives. Beyond fees, structured bonds carry risks that are less obvious than coupon reductions and price volatility. Model risk can cause valuations to diverge from realized outcomes dramatically during stressed markets when calibration assumptions break down. Counterparty risk and liquidity risk also matter because many structured products depend on a single dealer or a thin secondary market to honor their contingent claims. These interdependent risks can compound in adverse environments and reveal hidden tail exposures. If you decide to evaluate a structured strategy, start with a simple framework that connects the product directly to your objective and your alternative options. Ask whether the product's payoff matches a real need or replicates something you could assemble more transparently. Elsewhere, insist on scenario analysis, a clear breakdown of embedded costs, and documentation of counterparty strength. If those answers are evasive or overly technical without clarity, treat them as red flags rather than badges of sophistication. Use quantitative tools to stress test the bond across realistic market scenarios, and ask for the assumptions behind every model input that materially affects payouts. Run stress cases for interest rates, volatility spikes, credit events, and correlated market moves to see how the product behaves. If you cannot reproduce the payoff profile in a simple spreadsheet, or if the dealer refuses to show sensitivity to input changes, then the product's complexity may be serving the seller more than the buyer. Here is a practical checklist that you can use before writing a contract or signing into a structured bond. Confirm the economic objective, list clear alternative strategies, quantify the incremental cost, and document the counterparty's obligations in plain language. Also validate liquidity assumptions and obtain third-party valuations where possible, because independent checks reduce the information asymmetry that favors the seller. A disciplined checklist transforms subjective persuasion into an objective decision. Let us look at a real example where structured thinking helped an investor achieve a reasonable outcome with complexity that actually mattered. Imagine a pension fund needing downside protection against extreme market losses, while preserving upside participation for retirees. A principle. Protected structured note with a defined maturity matched to the liability timeline could provide that asymmetric payoff more cheaply than a portfolio of long-duration government bonds, plus expensive, long-dated options. In this specific case, the alignment between need and structure justified the complexity. Another real example involves yield, seeking investors who accepted equity exposure via reverse convertibles to obtain higher coupons during low-rate environments. Those structures provide attractive regular income, but they also deliver equity delivery under certain conditions that investors must accept. When the investor has a neutral to modestly bullish view on the reference equity and can tolerate occasional stock delivery, the economics can make sense. But this logic collapses if the investor misunderstands the risk of steep downside outcomes during stressed market periods. There are also stark cautionary examples where structured products failed investors dramatically during crises, because hidden correlations and leverage amplified losses. The global financial crisis exposed how mispriced derivatives inside complex structures can create losses that dwarf perceived safeguards. These historical failures teach a clear lesson. Structure can conceal systemic linkages and model fragility that only become visible in extreme conditions. Because those conditions are the most expensive moments to test promises, skepticism is a valuable investor tool. If your objective is to capture similar payoffs to structured bonds without surrendering transparency, there are often simpler building blocks that replicate the essential economics. For instance, owning plain bonds and pairing them with exchange traded options can mimic many structured payoff shapes at lower cost. A laddered bond portfolio combined with liquid exchange traded options allows you to control maturity, yield, and downside protection with clear pricing and accessible liquidity. Simplicity also enables easier monitoring and more accurate cost comparisons. Replication requires careful consideration of transaction costs and tax consequences, but these factors are usually easier to model and compare than the opaque pricing inside many structured notes. Using liquid instruments provides the additional advantage of being able to unwind positions without complex valuations. In other words, simplicity often yields both lower financial friction and greater strategic flexibility when markets move in unexpected ways. That flexibility is a practical value that structured complexity rarely delivers at retail scale. There are explicit scenarios where you should avoid structured bonds entirely, because the incentives and information asymmetries simply do not align in your favor. Avoid them when you cannot independently verify pricing, when the counterparty concentration is high, or when liquidity is uncertain. Also, avoid structured notes, when the product's success depends on narrow model assumptions about volatility or correlation that you cannot either stress test or hedge cheaply elsewhere. Those are situations where the product becomes a bet on model robustness, rather than an investment in underpinning cash flows. If you are an advisor or allocator, aligning incentives changes everything in structured product decisions, because many conflicts of interest lie buried under complex payoffs. Ask who benefits from each feature of the product and whether that person is the seller or you as the buyer. True alignment means transparency about pricing, independent valuation, and contractual clarity about how triggers and early terminations work. Without that alignment, the product more closely resembles a packaged sale than a bespoke solution. A simple decision rubric helps define the need, list alternatives, cost them transparently, and require reproducible payoffs under stress. If the structured bond clears those tests with convincing quantitative and legal documentation, it can be considered seriously. If the product fails any of those steps, or if the seller resists independent valuation, then the sensible choice is to walk away and build the exposure elsewhere. Discipline beats cleverness. When money and livelihoods are at stake, complexity should be treated as a tool rather than a virtue, because tools only justify themselves when used for the right purpose. Structured bonds are powerful instruments for constrained problems, but they are poor substitutes for clear thinking about objectives, costs, and alternatives. In practice, the best investors combine humility about modeling limits with insistence on transparency and repeatable outcomes. That posture allows them to know when to accept structure and when to insist on simplicity instead. A philosophical twist: complexity often seduces because it signals intelligence, not because it signals effectiveness. The real measure of any financial instrument is whether it helps you navigate uncertainty, not whether it confounds your opponent with algebra. Choosing clarity over complexity is therefore not an ethical abdication, but a pragmatic elevation of outcomes over appearances. When money is on the line, clarity becomes a competitive advantage rather than a concession. So what should you do next if you are considering a structured bond sale or proposal in your portfolio today? First, identify the exact outcome you want and write it down in measurable terms, because vagueness invites complexity that serves salesmanship. Second, request independent valuation and insist on scenario analysis that you can reproduce, because reproducibility separates genuine tailoring from clever obfuscation. Third, compare the solution against simple building blocks and choose the cheaper, clearer alternative when outcomes are similar. If this video changed the way you think about structured bonds, consider that clarity is portable across all financial decisions and scales better than cleverness. Whether you manage millions or a small retirement account, the same principles hold: align incentives, demand transparency, and prefer reproducible outcomes. If this perspective gave you a new tool for evaluating investment offers, hit subscribe to get more clear, evidence-based finance videos. Your future self will thank you for insisting on simplicity when complexity offers only the illusion of mastery.